what's going on, everybody? It is Tuesday, February 22nd. It's 2/22/22. For some people, that has a lot of importance. I'm not sure what, but that's supposed to have some kind of significance. Anyway, you saw what happened today. The escalation in this very tense and dangerous situation continues. Russia has sent its armed forces into the disputed region, the Donbass region. The White House went from calling it an incursion to a full-on invasion. Biden made a speech this afternoon rolling out a bunch of sanctions. Germany canceled the Nord Stream 2, the certification of Nord Stream 2. So things are a big mess, and because I think Biden said, there's going to be incremental application of these sanctions, to me it just seems like an escalation of the situation is what is in the cards. Now, the market was down way worse than where it closed, but it wasn't a strong close. It just wasn't a strong close, and I suspect that since we're facing the prospect of escalation, Putin has asked his government, the Duma, for authority to send Russian forces, into externally. So to use the use of Russian military, outside of Russia. So that was granted, and that's being construed as preparations for a full-scale invasion of Kuwait. It's a mess. The whole thing is a freaking mess, and it would be, something that would be just an afterthought if it weren't for the fact that we're dealing with the world's two largest nuclear superpowers. I mean, it's a dangerous, tense, it's a terrible situation. I don't know how else to describe it. I totally understand the jitters of the markets, and I think because we're facing the likelihood of an escalation in this situation, that at least in the short term, things are looking pretty shaky, unfortunately. Again, this channel is not a geopolitical or a political channel. I've tried to keep this, about economics, about investing, and most importantly, about seeing things through the lens of MMT, but this supersedes everything right now. It's having a major impact on market psychology and the markets. So today's rebound, we'll see what happened. I mean, intraday, early this morning, the S&P futures hit 4250 or 4260. I think we got down there again intraday during the day at the worst point, and then we bounced off of that. So for now, that looks like it's holding, but I have some skepticism as to whether or not that's going to continue to hold, just because, as I said, the situation to me looks like it's just going to escalate. There's going to be more sanctions. Russia's going to respond to that. Then there's going to be more sanctions. We don't know where it's going to lead. This is the problem with war in general, is that it is completely and totally unpredictable. And this is a situation never before seen because we're dealing with two nuclear superpowers. Anyway, I want to get off this subject just to talk about something else. Basically, here's a question I have for you. Why are interest rate hikes considered a tightening? It's a serious question. I'm asking it. Why are people saying that rate hikes are a tightening? And I went back and I did some research on this. First of all, before I even get into the research, let me just say that the non-government, that's us and foreigners and everybody who is not the U.S. government, we are creditors to the U.S. government. And that's true by just sheer logic of the fact that we hold $23.6 trillion in U.S. government debt. That's the amount of debt held by the public worldwide, $23.6 trillion. We are the creditors. We hear about the government having so much debt. Well, guess what? For every debtor, there's a creditor. We are the creditors. We hold out those treasuries. As such, rate hikes necessarily cause the government to pay us more money, not individually, unfortunately, but in the aggregate. Because we are the creditors and because we hold that debt, rate hikes necessarily increase those interest payments. That's income. So income goes up. And when income goes up, I don't see how you construe that as a tightening, number one. Number two, that interest income is used for spending and investing. People use that interest income, institutions use that income to spend and invest. So it's a fiscal transfer. It is an income transfer. It is a fiscal flow. It is a net injection of income. That's number two. That's number two why it's not a tightening. Number three, I hear the argument that, well, it's going to reduce borrowing, which is, again, not true if you look at the data. If you look at the period, and I've gone back through many different periods, but I'll just cite one example, and I'd be happy to, go over the other examples going way back. But right now I have this one off the top of my head. From December 2015 until December 2018, the Federal Reserve raised interest rates 9 times. 9 rate hikes, okay, in 3 years. And guess what? Loans at commercial banks increased by 17%. There was a 17% increase in the amount of loans outstanding at commercial banks, even though we had 9 rate hikes. All right? Conversely, from April 2020 until right now, actually, the Fed reversed all of those rate hikes, essentially bringing rates down to 0. And loans outstanding at commercial banks, in other words, the growth of the amount of loans went up 1.9%. Let's call it 2%. So you had a period where you had 9 rate hikes over a period of 3 years, and bank credit expanded by, 17%. And then you had a period where rates were brought down to 0, unprecedented, and held there. And loans expanded by 2%. And I've done other research to this effect where I've gone back and I've looked at other periods of time when we've had rate increases and what has transpired with loans and rate cuts and the same type of thing. And in all of these instances, all right, we've seen an expansion in bank credit and lending when rates went up. And we've seen either a slower expansion in loans and leases when rates were cut. Now, those are the facts. So I've just spelled out 3 things for you. Number one, we are creditors to the government because we, the public, and you can look it up. The public owns $23.6 trillion. The other $6 trillion basically is owned by the Fed. So we own 23.6 trillion. And by the way, the Fed gets paid too. I mean, the Treasury pays interest to the Fed, which the Fed ends up giving back. We own 23.6 trillion. We are creditors to the U.S. government to the tune of 23.6 trillion. All right? When the Fed raises interest rates, that increases the interest income flow to us, the creditors. Now, for me, I don't know about you, but when I get more money, and I'm not saying I'm holding treasuries, but I'm just saying, I use me as an example just, to describe the situation. When I get more money, or when somebody gets more money, I don't think that person would say they've experienced a tightening in their condition. I mean, they just wouldn't. And if you want to look at the reverse argument, we as creditors, when the Fed cuts interest rates, that reduces that income flow. That's a tightening. That is a tightening. Okay? And again, I've pointed out that in cases where we have seen historically interest rates being cut, the growth in loans at commercial banks, okay, bank credit, has been slower than in periods when we have seen interest rates go up. That's just a fact. And it makes sense to me. You might say, well, the causality is spurious, like you may be drawing a conclusion when it's just coincidental. But no, because look, once again, if your income goes up by any means, whether it's, you get a pay raise or whether it's an interest income flow that increases to you, you become more credit worthy. Like if you're going for a loan, the banks are going to look at your balance sheet, it's going to look at your finances, it's going to look at your income, it's going to look at your assets, it's going to look at your debt, and it's going to make a determination based on that. And if all else stays the same, if your debt stays the same and then your income goes up, your net worth has just gone up. So you're more credit worthy. It makes total sense to me. It makes total sense to me. So, you don't have to believe it. And yes, I understand that debtors in those situations where interest rates go up, they have to pay more. But we are net creditors by virtue of the fact that we hold $23.6 trillion in U.S. debt. That's just a fact. So, you can believe whatever you want to believe, but for me, and it'll be borne out this way, believe me, we'll see this when it actually happens. Now, I wish I could separate this geopolitical stuff out of the equation, because this could, kind of muddy the picture. If we have an escalation on top of an escalation on top of an escalation, then the market is just going to be, it's going to be terrible for a period of time. We need things to cool down. We need things to calm down. The idea of peacekeepers, to me personally, that's what's needed. But as it's being portrayed as invasion and now the U.S. and the allies in Europe going to take new steps, that's just an escalation. But as far as monetary policy is concerned, and again, I've said this many times, monetary policy is a mental illness. It's been, we've embraced monetarism. And when I say we, most of the countries of the world, in terms of their economic policy, they've abrogated, fiscal, and they've embraced monetarism as this paradigm of managing the economy. It just absolutely doesn't work. But we've embraced monetarism and this belief in central banks having the ability to regulate the economy and employment. It's bogus. It's ridiculous. It's not even ridiculous. It's just backwards. It's backwards. And I've explained, at least in one instance, in this instance, how it's backwards. It is not rate hikes. There is no way that rate hikes are a tightening. Just by pure mathematics, by pure arithmetic, we are net creditors. Our income goes up. We become more credit worthy. The numbers bear it out. It does not reduce borrowing. It does not reduce the growth in bank credit. No, it does not. Now, here's another thing I want to talk about. The fiscal flows. We're looking at about a $535 billion month. Now, this is a little bit lower than what I was originally expecting. I thought with the 45 billion, because at the beginning of the month we were running very hot, and I thought with the 45 billion quarterly interest payment this month in February, we'd be over 600 billion. We're not going to be over 600 billion. We're going to be right around 535, 540, something like that, which is a good month. That's what? That's like 30% higher than what we saw in the pre-pandemic months, okay? When Trump was there pre-pandemic, we were running about 420 billion a month, and that was enough to keep the stock market on a very nice upward trajectory. And I still think that number is enough to keep the stock market on a nice upward trajectory, but not the same as when we were in the full-blown pandemic, and that was accompanied with massive massive, unprecedented stimulus when we were running, 650, 700, even 980 billion a month. Think about it. That is a big, big adjustment downward. So growth is slowing down, but there's still growth. I believe that's enough that we're still going to have growth. It's not going to be, we're not going to see 7% like we saw in the fourth quarter. But we're going to get back into that range of 2.5%, 3%, which historically, that's kind of like where the economy has been. That's been the sweet spot. But it also makes the stock market subject to normal fluctuations back and forth. All right? It's not like when we were going straight up during the pandemic because they were pumping $1 trillion a month. I mean, $1 trillion a month. Last March, that's what we had. $1 trillion in 1 month. And this March, we might have 490 billion, less than half, okay? But that's still up. That's still going to be up about 20% from where we are in the pre-pandemic. You just got to be, got to be a little bit more patient on this now. And what is compounding the difficulty is what's going on right now in Ukraine, between Ukraine, Russia, NATO, United States. It's bad news. I may have to switch this totally to a political channel for a while because this takes front and center over everything else. It's bad. This is bad news. Again, I don't have to repeat it, but I will. We're talking about a potential confrontation or, dare I say, war between two nuclear superpowers. This thing is just going to keep escalating with sanctions and then Russian responses to those sanctions. And now Ukraine is talking about maybe, getting nukes again. The situation is just spiraling in a very dangerous way. I think it's really spiraling in a very dangerous way. I would love that things calm down. That there is actually a cessation of violence over there. That would be a great thing. And I think the markets initially thought, hey, it's good because Biden was just rolling out a very limited amount of sanctions. Like, Russian banks can't tap Western, loans and finance anymore, which I don't know how much of that they really were doing in the first place. So, the market bounced off of that, but then it kind of gave back towards the end of the trading day. And I think that's probably because escalation is in the cards. Now, we'll see. Like I said, we held the bottom of today's low. But I don't know. I don't know if that's going to hold because the situation is ongoing. It's in flux. And it's a bad situation. It is just a bad, bad situation. So we're going to see some really, really extreme negative sentiment numbers, which, me as a contrarian, when I see that, it's hard to hold back from not going in and plunging and buying. And I have been doing some buying on the downside. But I got to be honest, I am totally fixated on what's happening now from a geopolitical standpoint, and it's hard to focus on the economics because this thing is, I think it's dire. I really do. Anyway, I don't. I got too negative there myself at the end. All right, everybody, that's it for today. Have a good one. I'll see you tomorrow. Bye.